Welcome to Iron Financial. In a market that's filled with weakness, rust, and decay, we do the heavy lifting. We stress test the balance sheets, we dig into the financial filings, and we do it all to help you forge a stronger, more resilient portfolio. Today, we are putting SiriusXM directly under the microscope. This company, this stock, just made a move that has left Wall Street completely scratching its head. So we're here to do what we do best. Determine if this company is built on an ironclad foundation or if it's a financial trap just waiting to spring. Okay, let's dive right into the heart of it. On February 5th, SiriusXM reported its fourth quarter earnings. Now, looking at the headline number, they missed Wall Street's expectations for earnings per share by a colossal 69%. Let me say that again, 69%. Now, you know as well as I do, a miss that big is usually a death sentence for a stock. You'd expect it to get hammered. But instead of collapsing, the stock, SIRI, shot up over 8% in pre-market trading. This isn't just unusual, it's a paradox. Honestly, this is the kind of thing that gets my blood pumping. It's a financial puzzle that tells us the market, the smart money, is looking at something completely different from those headline numbers. Our job today is to figure out exactly what that is. Let's start digging. All right, before we get our hands dirty, we need a plan of attack, a blueprint. Skeptic, why don't you walk us through the roadmap for today's analysis?
Gladly. First, we're going to dissect this earnings paradox itself. Why a terrible-looking headline led to such a great day for the stock. Then, and this is my favorite part, I'll be pointing out all the cracks in the armor. We're talking about the obvious red flags that should make any cautious investor stop and think twice.
Okay, and after you've done your worst, I'll get to work. I'm going to dig into the foundation of strength, the steel that's hidden beneath the surface-level cracks.
Right. Then we'll pressure test what they are calling the future growth engine to see if this company is actually building for tomorrow or if it's just coasting on yesterday's fumes.
And finally, the big one. We deliver the iron financial verdict. Let's get to it. So let's get right into it, the earnings paradox. This is where the whole story begins, and it's a story that, on the surface, makes absolutely no sense at all. But listen, this is exactly the kind of situation we live for here at Iron Financial. Why? Because while the retail crowd is looking at the headlines and panicking, the smart money, the institutional money, they're busy reading the fine print. They're looking past all the noise to find the real signal. So let's pull the official documents ourselves and see exactly what it is they're seeing. Forget the news headlines for a minute. Forget the talking heads you see on TV. What you're looking at right here, this is the ground truth. It's the company's Form 8K, filed directly with the SEC. Now, yeah, it's dense, it's boring to most people, I get it. But for us at Iron Financial, this is the treasure map. We don't deal in rumors or speculation here. Our analysis is forged from the company's own official statements and its own financial data. The clues to solving our paradox? They're hidden right here, in black and white.
Okay, analysts, this is the slide that frames the entire puzzle for me. On the left side, you have a company-killing number, earnings per share missing the consensus estimate by almost 70%. Logic, gravity, common sense, everything dictates that stock should plummet. It should fall off a cliff. But then you look to the right and you see the market's actual reaction, a surge of over 8%. You've got to explain this to me, because right now all my alarm bells are ringing off the hook. This kind of disconnect is just screaming danger. What is the market seeing that I'm not? And that's exactly why we need to examine these cracks up close. Before I am willing to even consider the upside here, I need to see the risks. I need to know what could bring this whole thing crashing down. It is our duty to pressure test the weak points of any investment thesis. So let's put on our hard hats and start hammering away at the obvious structural weaknesses, starting with that jaw-dropping headline number that set all my alarms off in the first place. Let's not mince words here. A nearly 70% miss on earnings per share, that is not a minor stumble. It's not a slight miscalculation. It is a staggering failure to meet expectations. This isn't just a crack in the armor. This is a chasm. This is the kind of number that makes Wall Street analysts question their models and makes everyday investors question their sanity. It suggests a fundamental breakdown in one of two things, either the company's ability to generate profit or its ability to forecast its own performance. And frankly, neither one is a good look. And let's put some hard numbers on that percentage, because it's important. Wall Street was forecasting GAAP earnings of 77 cents per share. That was the consensus, that was the baseline for success. But SiriusXM came in with just 24 cents. That is a 53-cent miss for every single share outstanding. This isn't a rounding error we're talking about. This is a massive, massive deviation that points to some significant issues with profitability in the fourth quarter.
You can't just brush this off as a bad day at the office. Something went wrong here.
And if you think I'm just harping on one bad number from one bad quarter, you are mistaken. The crucial point here, the thing you have to understand, is that this EPS miss isn't some isolated incident. It's the tip of an iceberg. It's the most visible symptom of a much deeper set of problems that I see festering in the company's core business model. So let's look at what's happening with their single most important asset, their subscribers.
301,000. Just let that number sit for a moment. That is the net loss of self-pay subscribers for the full year. This is the lifeblood of their entire business model. These are the people who willingly open their wallets every single month to pay for the service. And over the course of an entire year, they lost a city's worth of them. This isn't just a crack in the armor, analyst. To me, this is the sound of the foundation eroding. A subscription business that is losing subscribers is a business that is fundamentally going in the wrong direction. Period. So let's assemble the bear case. This is my structural integrity report, and frankly, it looks bad. First, you have the massive Q4 earnings miss. We've hammered that one home. Then you have a shrinking base of paying customers. On top of that, their guidance for next year's revenue is completely flat, signaling zero top-line growth. In fact, their total revenue for this past year actually declined by 2% from the year before. And the most critical component, their subscription revenue, the very core of this business, is shrinking. Analysts, I don't see how you can look at these numbers and see anything other than a business that's in terminal decline. Prove me wrong.
You know, you've made a compelling case. You've pointed out every surface-level crack, every little bit of chipped paint, and you're not wrong about any of it. But what you're doing is judging a skyscraper by looking at the cracks in the sidewalk out front. You're completely ignoring the steel framework that's buried deep in the bedrock. So now it's time to stop looking at the superficial weaknesses and start doing the real heavy lifting. It's time to dig down to the real numbers, the numbers that the institutional investors are actually focused on. And this, right here, this chart brilliantly illustrates the real story. Just forget the quarterly EPS noise for 1 second and look at the full year picture with me. The year before last, in 2024, SiriusXM posted a net loss of over $2 billion. That's a catastrophic number. This past year, 2025, they swung to a net income of $805 million. Let that sink in. That is a nearly $3 billion positive swing in net income in a single year. This isn't just turning a corner. This is blasting a brand new highway through a mountain. It shows a company that has massively and successfully re-engineered its entire profitability structure.
Now, net income is important, don't get me wrong, but at Iron Financial, we worship at the altar of free cash flow. Why? It's simple. Because earnings, or net income, can be manipulated with accounting tricks. Things like depreciation schedules or one-time non-cash write-offs can make profits look bigger or smaller than they really are. But free cash flow? That's different. That's cold, hard cash. It's the tangible money left over after all the bills are paid and all the necessary investments are made. It doesn't lie. It's what you use to pay down debt, to reward your shareholders, and to invest in the future. It is the ultimate measure of financial strength.
And here it is. This is the number that solves the paradox. $1.26 billion. That is SiriusXM's free cash flow for the full year. That is a company record. It exceeded their own guidance by over $100 million. This is the metric that smart money cares about. They looked right past the noisy, messy GAAP EPS number for one quarter and saw a cash-generating machine that is firing on all cylinders and breaking its own records. This number screams financial discipline and operational excellence. This is the signal through all that noise you were talking about.
And look, this isn't just my interpretation of the numbers. This is straight from the horse's mouth. Listen to what the CEO, Jennifer Witz, told investors on the earnings call. She said, "Our focus remains on financial discipline and continued free cash flow growth toward our $1.5 billion 2027 objective." Management is telling you explicitly what their priority is. They are not focused on chasing subscribers at any cost. No, they are focused on maximizing the cash this business generates. They've even put a clear number on it, $1.5 billion in free cash flow within 2 years. That's their target. And what does a company with a mountain of cash do? It rewards the owners of the business, which are the shareholders. Last year alone, SiriusXM returned over $500 million to them. The vast majority of that, $365 million, was through dividends paid directly into investors' brokerage accounts. The rest was used to buy back stock, which increases the value of all the remaining shares. This is not the action of a company in distress. This is the hallmark of a confident, financially robust enterprise that is generating more cash than it knows what to do with.
So let's assemble the bull case. This is the steel framework that the market is seeing. You've got record-breaking free cash flow of over $1.2 billion, a massive, nearly $2.9 billion turnaround in net income. They use that cash to reduce their total debt by $669 million, strengthening their balance sheet. They returned over $500 million directly to shareholders, and they just declared another healthy quarterly dividend. This isn't a story about decay. This is a story about a cash flow engine being fine-tuned for maximum efficiency and maximum shareholder value.
Okay, I'll concede. The cash flow numbers are impressive. It's really hard to argue with $1 billion in cash. But a company can't just cut its way to prosperity forever. A healthy company needs to grow. What you've shown me is a company that is excellent at managing a stable, or, let's be honest, even a slightly declining business. But where is the growth? Is this a cash cow that's just going to be milked until it's completely dry? Or is there a real plan to build something new? So analyst, show me the future, because right now all I see is a company that's great at managing its past.
That's a fair challenge. A business absolutely needs a forward-looking strategy, and management has laid out a very clear three-pronged plan. First, you're right. They're continuing their aggressive focus on efficiency. They saved $250 million last year and are targeting another $100 million in savings this year. That directly fuels the cash flow engine we just talked about. Second, they are expanding into new territory, specifically podcasting, where their ad revenue grew an incredible 41% last year. And third, they are fortifying their core business by focusing on retaining the customers they already have, and they achieved a record low annual churn rate of just 1.5%. So this isn't a company that's standing still. It's optimizing its core while strategically planting seeds for new growth.
41% growth in podcasting sounds great on a slide. I'll give you that. But let's be realistic here. Podcasting is an absolute knife fight. You are competing with Spotify, Apple, YouTube, and literally a million independent creators. Even with impressive growth, it's still a smaller piece of their overall revenue pie. Can growth in a hyper-competitive, lower-margin advertising business truly move the needle for an $8.5 billion company? Or is it just a shiny object, a distraction from the fact that their core, high-margin subscription business is slowly bleeding subscribers? But that's where the turn reduction comes in. They're plugging the leaks in the ship. Plugging leaks is one thing, building a new ship is another. I'm just not convinced this podcasting venture is a growth engine. To me, it sounds more like a side project.
And that, right there, is the central question we have to answer. You've laid out the risks, the very real structural weaknesses in the business model. And I've laid out the financial bedrock, the incredible cash generation and the balance sheet strength. Both cases have merit. So now it's time to put it all on the scales. We have to weigh the evidence from both sides and deliver the final, actionable, iron financial verdict. Is this an opportunity for a savvy investor who looks past the scary headlines, or is it a classic value trap waiting to snap shut?
All right, let's go head-to-head on this. I still can't get past this shrinking subscriber base. It's the foundation of the business, and it is cracking. But the foundation isn't subscribers anymore, skeptic. It's cash flow. They are proving they can generate record cash even with fewer subscribers. That's efficiency, not decay.
Efficiency is just managing a decline gracefully. Flat revenue guidance tells me there is no growth story here. This business is mature and maybe it's past its prime.
The growth is in podcasting. It's a beachhead in a new market, and it's funded entirely by the cash from the core business.
And they're not just throwing money at it. They're showing 41% growth. That's growth in a brutal, low-margin street fight. Meanwhile, their high-margin core business is losing ground. I just see a company treading water.
And I see a financial fortress. Record cash flow, strong profitability, disciplined debt reduction, and a massive dividend. That is not treading water, my friend. That's building a stronghold.
So, what is the iron financial verdict? Let's bring it all home. SiriusXM is not the high-growth tech stock it once was. The skeptics' concerns about the core subscription business are valid, and they absolutely cannot be ignored. And on the other hand, the analysts' points about the financial strength are undeniable. That free cash flow is a fortress. The balance sheet is solid steel. Exactly. So our verdict is this. SiriusXM is not a trap for the investor who understands exactly what they are buying. It's a financial engine that's built for durability, not for speed. It's a play on management's ability to maximize cash from a stable asset and return that cash directly to its shareholders. But it is a trap for anyone who's out there chasing explosive growth. If that's what you're looking for, this is not it. Which leaves every potential investor with the one question that really matters. In this uncertain economic environment, is that cash flow engine truly built to last? That's what you need to decide.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.